Hello, welcome listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I'm joined by Gabriele Gramazio from our European Structured Credit team. Welcome, Gabriele.
Hi, Gordon, and thank you for having me.
Today we will be covering the topic of the development of a middle market or direct lending CLO market in Europe. A report on the topic titled Private Credit, Potential for European Middle Market and Direct Lending CLOs can be found on kbra.com, along with a number of similar publications on the topic of private credit, including one recent publication from our private credit team highlighting the topic of a maturity wall in 2024 in U.S. private credit. Go and have a read. KBRA has observed increasing momentum in the formation of a European middle market, including the potential participation in the capital markets via collateralized loan obligations and other direct lending vehicles. This all comes amidst the backdrop of a rapid expansion of global private credit in Europe. Despite diversification and regional differences that pose challenges for portfolio construction within Europe, it is more a question of when, rather than if, Europe will see its first middle market or direct lending CLO. All right, Gabriele, let's get to it. With the backdrop of the situation here in Europe and why we are seeing this increased interest in middle market CLOs and direct lending CLOs, what is the reason behind this?
Yeah, absolutely, Gordon. Look, as you mentioned before, I think this is really the result of what we have observed in the last few years of the rapid growth in private credit in Europe. So we start from a situation where historically European banks have been the most common providers of corporate loans, and they still are. But what happened in the aftermath of the global financial crisis was that these banks have reduced their lending capacity. And this was due to a number of reasons, starting with regulatory measures, balance sheet constraints, and tighter lending standards, but also because of more activity in the BSL markets. So now that you have these direct lenders, these new participants have been able to lend directly to this segment of the market was potentially underserved.
Yes, it has been astonishing how much this segment of the market has grown. According to Preqin, the global private credit assets under management totaled over $1.7 trillion US dollars as of June 2023. North America represents a really high proportion of this, but Europe is rapidly growing as well, and it is just under a third of the private credit market by size. So there are more assets competing with the banks for lendings. How does this feed into the prospect for the use of securitization technology to help expand the growth further?
Yeah, look, these private credit lenders will need to access the capital markets and to distribute their private credit exposure to the more traditional asset manager, but also to the non-bank financial institutions. So that could be really the main driver behind using the securitization to distribute this exposure. While this growth has been very strong in Europe, in the more mature markets of Western and Northern Europe, private credit represents just the 2/3 of the financing for middle market buyouts. There's around 90% in the US. So that means that there is still space to grow.
So these lenders are just looking at ways to expand their footprint further? I mean, I assume investors are ready for this.
Yeah, you're absolutely right. Look at the example of the broadly syndicated loan market in Europe. This one has expanded rapidly over the past 10 years to the point that now is one of the dominant buyer of the larger leveraged loans in Europe. So an expansion into some of the smaller loans and the trench risk exposure should still be appealing for the investors. If we look at the US, right, because we always do that, because it's a bigger market, it's more advanced, and we see the trend that then are reflected into the European market. The middle market CLO has been active for a number of years now. And last year was particularly important, so the 2023, because it was the year in which the size of the market represented 25% of the corporate CLO issuance. So that was a record year.
Okay, so let's dig in a bit into how you would look at these types of transactions. CLOs, along with funds and business development companies and revolving credit facilities, have been the vehicles used by direct lenders to access institutional capital and fund their direct lending activities. So, how does a middle market CLO differ from a traditional broadly syndicated loan CLO?
Yeah, look, generically speaking, at least this is our experience of the US market. So middle market CLOs, they tend to be collateralized by a portfolio of loans that have been directly originated by the managers, by this direct lender. And typically, these are like private leveraged loans, and they do not trade on the secondary market. Neither they have a public ratings. The sort of strategy that these vehicles have, it's very often a buy and hold format. And this is in contrast with the broadly syndicated loans, where effectively these are vehicles that are extremely acting in trading asset in the secondary to adjust to a certain risk return and to maximize the arbitrage and the excess spread for the transaction. So the middle market, it's quite of a different animal, if you want. PSL CLOs managers are more credit pickers, right? Looking to continually rebalance the portfolio. With middle market, it's really origination. It's all about the origination. And with the origination, often comes the capability of the managers of the direct lender to specialize in some niche, which can be, sectors. Typically, we see a lot of growth in the software industries, but also on the type of lending. So we're talking about unitranche, we're talking about asset-based lending, among other things. So these specialties ultimately drive not only the eligible loan types and portfolio limitation in the transaction, but also in the context of, the rated transaction, the overall view of the portfolio credit quality and what could be the potential default under a certain given rating scenario.
Thanks for bringing up the rating angle. That was going to be my next question. You highlighted the points of distinction between the BSL CLOs and the middle market CLOs and their underlying collateral. But given the difference between these types of loans, presumably their evaluation requires a different approach.
Absolutely. So this is like one of the main differences between BSL and middle market. Because as we mentioned before, these loans are actually private loans. There is not such a thing like a public ratings, public reporting on a certain quarterly basis, let's say. So these credits were typically analyzed by KBRA, and credit estimates or a credit assessment is determined to provide an indication of the credit worthiness of the unrated issuer or the issuer obligation. So bear with me, credit estimates are unpublished and confidential, and they are not distributed to third parties. So effectively are used by KBRA's analysts to perform and to assess the credit quality of the portfolio. KBRA credit assessments, instead, are generally made available to the managers and to the trustee for the purposes of checking compliance to the transaction test and concentration limitation.
Yes, and I understand that through our activities in both CLOs and funds, KBRA has performed over 3,000 credit assessments of mostly privately sponsored middle market companies across a number of middle market CLOs, business development companies, and private credit fund portfolios. That's a pretty impressive number. Any notable characteristics from these ratings?
Yeah, this is a big number, as you say. I think what we can extrapolate is that most of these assessment they comes in the area of the single B, the triple C. So why is that? Well, that really reflects borrower high financial leverage. And in some cases, which is specific to this market, is that sometimes we have a reduced performance track record for some of these company, also because of the frequent M&A activity for which these company are sometimes involved. Now, these also will have an impact on the securitization product itself. In fact, middle market CLOs, they typically have a higher allowance for these lower rated assets than their BSL counterparts before any penalties come into effect. And in most cases, these credit assessments are meant to be utilized in the analysis of a portfolio's overall credit quality rather than being used on a standalone basis, on an individual basis. Now, from a European angle, obligors tends also to be smaller compared to their US peers. And as a result, the level of information could be limited, and this could be an issue.
Okay, thank you. The report, of course, contains a fantastic write-up on how you look at the various aspects of our evaluation of this type of loan pool in greater detail. But can you quickly give us an overview of a few of the main points of your evaluation?
Yeah, absolutely. Look, portfolio are obviously more concentrated, either in terms of number of obligors, but also in terms of industries, simply because these reflect the kind of lending of the direct lender, of the individual direct lending platforms. So for vehicles that are still in their investment periods, portfolio could be composed of anywhere between 50 and 75 unique obligors, although what we have seen in the US is that these middle market CLOs tend to be well diversified, while typically the CLO framework usually also have some limitation in terms of higher single obligor exposure to keep the portfolio well diversified. While for a BSL CLO, this is typically the largest exposure is typically between 2 and 10%, depending on the seniority of the loan. These limits obviously are higher to 3 and 5% for middle market CLO, simply because to accommodate the higher concentration. Same can be said for the industries. Typically in BSL, CLO, the top three industry concentration shouldn't be higher than 40%. And in middle market CLO, this concentration is higher and it's around 50%.
In Europe, obviously, the concentration is exacerbated by the regional nature of some of these markets. How do managers deal with this issue?
Look, it is exactly the case. We always focus on this point for European transaction. This is not a surprise because direct lenders have focused on one or two European jurisdiction and on a restricted number of sectors where they have built their expertise. So it doesn't come to any surprise. And this is actually has been an element that have affected the ability of direct lenders to generate enough loan supply to form a CLO portfolio. Maybe this is a reason why we haven't seen a proper middle market CLO being marketed yet. In addition, there are, the quirkiness of the European system in which you have various jurisdictions with various recovery regimes to the complexity. And this could lead, for instance, to a dispersion in recovery rates when coupled with the smaller overall size of each obligor. Obviously, all these issues can be partially be offset through the portfolio effect with more diversity.
In the US, KBRA has been involved in a number of transactions that contain portfolios of what are referred to as recurring revenue loans. How do these work, and are there other unique characteristics to loans included in direct lending pools?
Yeah, so in this kind of middle market CLO or in other private credit portfolio, we have observed a number of different assets which are not the typical, senior secured loans. So we mentioned before unitranche, then what we often see are first lien, last out. There is quite a bit of second lien, and in some cases, as you mentioned, the recurring revenue loans. So this company derive a substantial portion of their revenue through the recurring and predictable sources, such as periodic subscription fees. So most of the time, these companies are in the software tech industries. They rely on subscription of their softwares, and the underwriting, rather than being done on the EBITDA of this company, is actually done on the revenues, on the recurring revenues that the company is able to generate. And these companies typically are in the early stage of their growth phase. The credit assessment, as a consequence, sometimes could be on average lower than the one for BSL, but sometimes also for some of the middle market. So depending on a particular manager expertise, these types of loan can be creative to structure from a yield perspective, but have different structure of risk, which may reduce the recovery profile of a CLO, all else equal.
In terms of rating analysis, how do BSL CLOs and middle market CLOs compare against each other?
In KBRA, we have created this tool, which is called the KBAT, the KBRA Portfolio Analysis Tool, which is available on our website and everybody can download it. It's a formulaic tool that considers diversity profile and other characteristic of the portfolio to project a portfolio expected loss rate under a specific rating stress. So, the typical factors that the tool will models are effectively industry concentration, obligor concentration, the individual ratings of each obligor in the portfolio, but also how long is their investment period and the weighted average life of these portfolios. In the report that you can access on our website, we provided with an example of the KBAT results for a typical BSL CLO in comparison to what could be an hypothetical middle market CLO for Europe in particular. You will see that, broadly speaking, due to the reduced diversity and lower credit assessment, typically a middle market CLO portfolio will generally have higher default rates relatively to a BSL. Again, higher defaults can be offset, obviously, in a structure by either additional par subordination or by a higher excess spread. So the KBAT will only tell you where we think our defaults and recovery will project based on a target rating.
Great. Thank you very much, Gabriele. That was all very insightful. KBRA broadly expects this trend of a growing private credit market to continue into 2024 as private credit managers will continue to compete with traditional capital markets. Deal volumes are likely to expand in number and size, and an increasing number of direct lenders will monitor different strategies to distribute some of these exposures and expand their footprint, including the use of middle market CLOs and other direct lending facilities. As highlighted in our report, KBRA is actively involved in the private credit market and prepared for the constantly evolving capital markets. While middle market and direct lending CLOs are off to a slow start in Europe compared to the US, as my Italian colleague will tell you, Rome was not built in a day. That's it from us today. As always, we hope these conversations in credit help to illuminate the many trends taking shape across the markets. For more in-depth coverage of the themes discussed today, or to learn more about our unique approach to credit, sign up to the KBRA website to read all our research. Have a topic idea or comment you'd like to share? Reach out to me or one of the KBRA analysts on today's episode. Be sure to subscribe to the podcast so that you can be notified when new content is available. Invite your colleagues as well. We'd love to count you all as informed listeners. This is Gordon Kerr, thanking you for being part of the conversation. Take care, everyone.